Hello, everyone, and welcome. Just to let you know on an admin thing that this is being recorded, this webinar is being recorded. It's really lovely to have you all join us here on the IFF Connect Cast webinar today. My name is Taya, and I'm joined by John Richardson, who works with us here at IFF. Today, we're here to host a webinar focusing on technology valuation and what to watch in 2023. Just to let you know, at the end of the webinar, we will be hosting a question and answer session. So if you would like to post your questions in the Q&A section at the bottom of your screens during the webinar, that would be great. We will run for 30 minutes and then have the question and answer session afterwards. I'll pass you over to John now. Maybe you could start with a little intro into yourself, John, and then some background into why technology valuation is different from corporate valuation and how the market's changed in 2023.
Okay, thanks, Taya, and welcome everyone to this short webinar. As Taya said, my name is John Richardson. I'm the Managing Director of a corporate finance advisory firm based in the UK, where we deal with a whole variety of different investment funds, credit funds, private equity, venture capital across Europe, Asia, Middle East and Africa. Really looking at the issues of investing in the market, either on the debt side or the equity side. I'm also a senior visiting lecturer at Bayes Business School in London, where I focus on issues of funding and valuation of transactions. And obviously, over the last few years, technology has been a real focus for everyone in the market. There's been a large amount of investment in that particular area, and therefore the whole issue of valuing those particular transactions or those opportunities has been the forefront in many people's minds. And I guess if you're thinking of it from the point of view of why is it different to corporate valuation, I think it goes back to the real sort of structure of technology type businesses, which is typically they're investing very heavily at an early stage in either infrastructure, software development, or maybe sales and marketing in terms of trying to develop their product or service in terms of whatever their focus might be in the market. And therefore, they're going to be heavily cash negative for quite a number of years. They're investing, obviously, to try and gain that market position. And the difficulty there is, how long will that take before the market accepts that technology and starts utilizing it? And of course, when you look at the length of time it takes, you've got some risk as to whether this is going to be successful and how successful will it be? What's the scale of the market that you're actually entering into? And therefore, at what point will it be cash generative? And it's that aspect of time and risk, which I think is the big difference from when we look at normal corporate valuation. Clearly, there are some similarities, because we're always looking at cash flow and the ability to generate cash flow. But I think a good example of that was the business that developed out of the Netherlands called Movea, which is motion sense technology. Because it took over 10 years from the time that they started to develop the idea of motion sense technology, and then they patented all the various ideas that they developed, until finally people could see how they could utilize that in applications. And of course, today it's used in so many different applications, and it's been sold off in the market to an investor in the US for a large amount of money. But it took a long time till actually people could see that opportunity, and in the jargon could create around that technology and therefore see how they could create value out of that. And I think that's the big difference when we start looking at it. You've got that particular problem of time and risk that we see in valuation. The market itself, of course, has been really interesting over the last few years. We've seen very rapid growth in terms of investment in this particular segment of the market in a variety of different technologies, of course, but if we take technology generally as a segment of the market. And I think it's a function of the availability of funds at a relatively cheap price, either equity or debt funding, that has really driven the multiples in the market and the price that people were willing to pay for those particular opportunities and those transactions. There's been actually quite a change, obviously, over the last year, where clearly the risk element of investing in that has become paramount. And people, I think, have switched, so that previously it was all about growth. Now it's all about value. So now it's all about trying to identify where is the cash generating opportunity here and how long is it going to take until we're comfortable that they're going to achieve that. And I think there's much more focus on that area. Clearly, there are always opportunities in any marketplace where you'll see differences in terms of people willing to pay a higher multiple to actually get into certain sectors. And we'll talk about this in a moment in terms of what sort of sectors perhaps are more attractive at the moment. But I think generally the change is that, you've gone from a growth focus to a value focus, and you've seen multiples drop quite considerably. Now, that could mean that previously there was a lot of overpricing in the market and there's more realism now, or maybe people have overdone it now and actually it's just dropped too much in the market. And that means there are significant opportunities now in terms of investing in those particular areas. So let's just have a look at some of these particular issues in terms of how this market is developing. I'll put some slides up. And as Taya said, you'll have access to all of these afterwards in terms of an ability to actually look at these particular issues in a little bit more detail. If we look at this in terms of the overall focus that we've seen over the last few years, go back to 2018, it was growth, I guess. People still looked at sensible economics in terms of cash. How are we spending cash? And what we're looking for, of course, is people who can find a repeatable, scalable business model at a price which is acceptable. So what have I got to invest to be able to achieve that growth? And it's always about that particular link, excuse me, between reinvestment and growth. We're always thinking about that. But of course, it changed in 2021, 2020 and 2021. It was growth at all costs. Money was relatively cheap, and people were really actually more interested in just getting into the market and being part of this particular growth area. Last year, it changed, and there's no doubt that people focus much more heavily on how can we get to this positive cash flow position? Is there a clear path that we can see that they're going to be into a positive position of generating cash and not just investing and using that cash, not just burning that particular cash? It means that now people are more cautious on businesses that require larger investments. So, things like hardware, banks, short delivery time businesses, 10-minute delivery businesses. Still appetite for sustainable development issues. So still appetite for green energy and those particular areas where obviously you've got a real focus on sustainability. Crypto, never know what's happening with that. It seems to change weekly. So it's a difficult one to predict, isn't it? But clearly, there are going to be opportunities in that area. The fact that rates have gone up obviously impacts the value from the point of view of discounting. So if you look at the present value of opportunities as you get higher interest rates, clearly, well, we're going to have an impact on that from a discount point of view. But if you set that against the fact that the really good tech companies can grow very quickly for quite a long time, provided you've got the market available for that. And so it's really important to say, what's the scale of this in terms of the market possibility that we have there? Can they continue to grow at that rate? But clearly good tech companies historically have been able to do that, and therefore they can justify high valuations. In other words, the growth offsets the risk issue when we look at that. But in the current market, we're seeing examples where companies have failed to fundraise, or they've fundraised at a much lower multiple in the market. But alternative, still opportunities where people are raising money at higher multiples. So, there's still quite a bit of variation out there in the marketplace. People are, I suppose, being a bit more selective in terms of how they look at this in the market. And when we look at it across the range of development of these businesses, you have quite a difference in terms of the availability of information as you start looking at the possibility to value these companies. Remember, when you're valuing, you're always looking in the future. We're always trying to understand what the future will be, and none of us can actually guess what the future is going to be. So it's always going to be wrong in terms of our estimate. We're trying to get a range of possibilities, and we're trying to come up with some logical explanations, some good assumptions as to why we think that's going to happen. At a very early stage, if we're thinking of it in terms of early stage, seed capital, angel investors, very early stage venture capital investors, you're probably pre-revenue, or you've got very limited revenue. You might be generating a gross margin in terms of gross profit. You're not generating an operating profit margin, so you've got no EBITDA and you're negative on cash. You've got to focus very heavily on the qualitative factors. And there are a number of different methodologies we can use to look at this from a more qualitative point of view. The emphasis there is very much on trying to understand the risk of achieving the actual growth. As we go through development, we start to get more information from a quantitative point of view. So we move from pre-revenue to post-revenue. We perhaps start generating close to a positive EBITDA. We might still be burning cash in terms of investing, but now we've got a bit more quantitative data. And that means we can start to validate some of our assumptions by looking at the quantitative nature of that business. As we move into a business which is more fully developed, you're into more traditional valuation methodologies, which are all cash flow based. So we're looking at a cash flow valuation model using discounted cash flow, or we're looking at transaction multiples, or we're looking at trading multiples. You know, there are a variety of things then we can start to look at which are a bit more traditional. Does it mean that traditional valuation is better than the qualitative? Absolutely not. It's just a different way of looking at the problem. And I think it's this combination of using qualitative data and quantitative data, which is the important element that we actually get here. I just see a chat message come in, Luca, saying, will we get the slides set at the end? Yes, you will, Luca. So all of this you'll get at the end of that. So you can use these as you wish in terms of the slides that I'm showing you. So it's really about trying to understand that particular difference in terms of where are we in terms of sector. So what do you think is most important in terms of valuing tech companies? A little poll question for you here. You know, what would you say is most important? Is it the business plan? Is it the management team? Is it the economic cycle? Is it sector momentum? What would you see as most important here? I'll give you a few seconds to just make your choice here. If you're looking at valuing technology businesses, where would you put the emphasis there? Because I think it's always an interesting problem in terms of how do we evaluate this from the data that we actually receive? How do we actually try to validate some of our assumptions in terms of what we're actually doing? So we'll see how those poll answers are coming in now, and then we'll show you the answer to that once we have a sufficient number of answers coming in, which I imagine we're getting towards that now. A few seconds. So here come the answers. Okay, management team. Yeah, I would say that clearly there's always a big emphasis, isn't there, on quality management, and people have got that experience in terms of the technology experience, in terms of developing that, but also the management experience of being able to actually run that business. Business plan, yeah, always important. I mean, you could argue all of these are important, of course, in terms of what you get. My point of view when I'm looking at it from valuing these businesses is it depends. It's really, it depends on where we are in the cycle. If we're at very early stage, so we're pre-revenue or just maybe generating a small amount of revenue, it's really all about the management team. And it's about their ability to pivot in terms of their ideas for developing that business to suit how the acceptance of the technology goes in that market. Because we're looking for this repeatable, scalable business model, and we're not sure that what we've got is actually going to achieve that at that very early stage, because we really haven't got anything to validate that. So you're relying on the management team to be able to react and pivot and change. And it's that flexibility that I'm interested in. Now, it's not to say I'm not going to look at the business plan and look at the market opportunities. Of course I will. But at that stage, the business plan, it's just a hope really at that point, because we're not sure what's going to happen. As we look at a business which is later stage, then actually the business plan starts to take more importance, because at that point, we've got a bit more data to validate it, because it'll be post-revenue, you'll be generating a gross profit, you might even be moving actually into a positive EBITDA or getting quite close to that. You'll still be burning cash and still be investing. But you've now perhaps got a customer base. You can understand how the product or service is working in that market. You can see the opportunity a little bit more. And at that point, the business plan becomes more important than management team. Management team is still important. I would never underestimate that. And the way it was explained to me years ago, it was by someone, I think, at JP Morgan who explained this to me. They said, think about horse racing. And if you bet on a horse race, what do you bet on? Do you bet on the horse or do you bet on the jockey? Because they're clearly both important, but which one do you attach most importance to? And if you're a venture capitalist, you're betting on the jockey, in other words, the management team. If you're a private equity investor, you're betting on the horse, in other words, the business plan. you'll still want to see a good management team. It's not underestimating that. So I think it depends on where we are in terms of the development of that business as to which particular focus we might have in terms of development of that. We'll still look at all the other elements, of course, but it's where you actually start to put the emphasis. And also, what data have we got to be able to validate this? And it leads into what I would call more vision-driven valuation methodologies if you're at a very early stage in terms of the development of that particular technology business. There's the Berkus method. That's Dave Berkus. He was a famous angel investor in the market, and he came up with this idea of 5 key concepts or 5 key factors. What's the concept? What's the prototype? What's the management team? What's the size of the market? Have we got any revenue? It was all about risk. What's the risk of each of these areas? I've got no financial data. I've got a forecast, but I've got no financial data that I can validate this with. So what risk have I got, and how do I de-risk this from the point of view of investing? Now, you could expand that a little and use a risk surveyation method where we look at a broader set of risk factors and we benchmark those and attach a value to each of these risk factors. Or you could do a weighted average of these, a scorecard methodology. And people will use all of these methods when they're looking at early stage development. This is where we haven't got the quantitative data. We've got a forecast, but that's just a forecast. That's just a hope in terms of what we see. So the Berkus method really was about a lot of these businesses will fail. That doesn't mean they go bankrupt. They just don't actually achieve their objectives. They never really scale up, in other words, in terms of what they're doing. We assume that they can achieve some minimum level in terms of revenue. 20 million, say, in terms of a minimum that we would achieve. So if you attach maybe in 5 years a revenue multiple of 5 to that, you've got 100 million business. If you're asking today for 2 million as an investment, and you think it might be worth 100 million in 5 years' time, you can say maybe my 2 million, I need a 10 times multiple on that as an investor to get some return. So I need 20 million out of that. That means I need 20% of your business. That's a typical venture capital way of looking at that, isn't it? And so, but you need a certain scale to be able to scale it up. It's typically pre-revenue, and you apply a certain value to each of these 5 risk factors, say 500,000 to each risk factor, which is usually the number that people will attach to this. It was published in an article called Winning Angels a number of years ago. And a lot of people will sort of look at it in this way, in terms of looking at these particular factors more from a risk point of view. It's simplistic. There are a large number of factors clearly that we could consider, but you've got very little data at that point. So, you've got to try and use something to come up with an idea of, which particular investments do I think are most attractive. If I broaden this out into a range of different risk factors, you can pick maybe 12 risk factors. Sometimes people will pick slightly more than that. And what you do is you assign a positive or negative value to each risk factor relative to other businesses. Maybe you say you go from +2 to -2 on each risk factor. And each of those particular numbers in terms of +2, +1 or 0, each one you attach a value to. Most people would choose something like £250,000, £250,000 for each risk factor. And then you sum up all the risk factors, pluses and minuses, and then you adjust the median investment value, use some angel data or PitchBook data, or whatever data set you look at for the median investment that people are making in that size of business, in that geographical area, in that area of technology. And you can get that data from various data sources. And then you just adjust the median value by those particular risk factors. So if I had a median value, say, of 2.5 million, that's the sort of average, the median investment in that particular type of technology at that stage of development. And I sum up all my risk factors and it comes to a positive +2. So I've got some positives, I've got some negatives. When I add them up, it's +2. Each risk factor is $250,000. So I've got an extra $500,000. So I'd say, that's about 3 million then. So 2.5 is the median. This one might be worth 3. It allows you to benchmark a little bit against other companies. Again, relatively simplistic, requires you to be able to get that sort of benchmark data, of course, and that can be problematic in practice. Another way of doing this, just use a scorecard, similar sort of idea, but what we do here is we actually have a multiple that we apply to different factors. So here's an example of one company that uses this in terms of an early stage scorecard type method. They start with a base value, 250,000, and then they adjust it, for the revenue, for any cash. Is it eligible for a tax scheme? The Enterprise Investment Scheme, EIS, is just a tax scheme for investors who might invest in those businesses, and so on in terms of an adjustment. And then they come up with a pre-money value, which they compare to the pitch that has been given to them in terms of the proposed pre-money value. And it means they can then benchmark various investments against each other and say which are the ones that actually we think are more attractive for us, and which are the ones there we go on to do some more due diligence in terms of looking at that opportunity. It depends upon how you scorecard it, of course, in terms of what you actually do. But variety of ways of looking at this from a more qualitative point of view. You haven't got a lot of quantitative data, so you've got to do something in terms of trying to understand that. The more quantitative methods are more traditional valuation-driven methods. So cash flow is an obvious one, if we can get the cash flow, but you've got a forecast, you've got a discount, and we all know the forecast is wrong, and we're never quite sure what the discount rate is going to be. So, there are significant problems in doing that. We can use multiples, so we can get some comparable multiples. If we can find something that is comparable, we can use comparable transactions in the market. But of course, that is really pricing, isn't it? There's a fundamental difference in valuation generally between price and value. The price is what you pay, the value is what you get, and they're not the same thing. When you're looking at comparable transactions, you're looking at pricing. And if everything is priced high in the market, you're going to have high comparable pricing. Doesn't mean the value necessarily is there. So you've got to be a little bit careful when you start using multiples in how you interpret that. You can use the venture capital approach, which is look at the end point, take a multiple in 5 years' time or 10 years' time, or what you think the revenue will be, and then discount it back at your investment cost. In other words, what do I want as a rate of return on that? And what does that equate to in terms of a discount rate to get a present value today? Well, that's a typical sort of venture capital way of looking at that particular investment. Or you can use some option technology, more likely use decision trees. That's been used in pharmaceuticals, in oil and gas for many years, where you look at a decision tree approach. And when you've actually got a technology business where you have staged investments, and that's usually the case, of course, because usually you need more money to develop that technology, you can actually look at each stage of the investment, the Series A, the Series B, etc., in terms of how we invest in this. And at each point, you can look at how it's developed and what's the probability that it will develop onto the next stage. What's the probability that it won't hit those sort of targets, those projections? And therefore, you can start to look at that on an option basis as what will it be worth given certain assumptions at each stage of its development. That's the decision tree approach, or a real option approach. And sometimes that's quite useful in terms of trying to understand at each point that you have to make a decision for a new investment. How is it developed to that point? How is it likely to develop further? And have I changed my view on that in terms of what will happen? The final one here is you could clearly look at the cost of development, and you could look at what is the replacement cost. So if I decided to replicate that technology, how much would it cost me? You've clearly got problems of infringement of patents and various other legal rights that may come if you start to do that. But that can give you an idea of how much that might be worth if I replicated it rather than if I had to buy it. And therefore, what is the difference between that in the marketplace? So sometimes that's useful in terms of looking at technology as well. It's always a case of thinking about, what are we actually trying to measure here in terms of the value? What are the drivers of this? Because we start off with our current cash flows. We forecast our cash flows. We end up with an end to our forecast because you can't forecast forever. And so we take a terminal value. This is the classic discounted cash flow model, isn't it? And we all know the problems with this. You have a huge amount of value usually in the terminal value. During that time, you make some new investments. You try to operate efficiently and generate more returns from those assets. And you try to extend the growth period. This is what they call sustainable competitive advantage. This is what we're trying to do in the market. We're trying to find this repeatable, scalable business model where we can lock in the customers and we can reduce the churn rate. We can reduce the way in which customers switch to something else. So how sustainable have we got in terms of what we're doing? Because the more sustainability we've got, the more value we create over a longer period of time. Eventually, we will decay. We're bound to. Nothing goes on forever in the market. And you've got to keep investing to keep replicating that. And then, of course, there's the risk of achieving this. What is the risk of getting there? And this is really, when we're talking about technology businesses, what we're trying to benchmark. What's the risk of acceptance of this technology in the market? What's the risk of somebody else coming in and replacing this? So when we actually look at it, you've really got three key things to think about: risk, growth, reinvestment. And that's the same for any valuation model. Whenever we look at anything, it's this combination of how much do I have to reinvest to achieve the growth? And growth in technology is important because I need to be able to exploit the technology and grow sufficiently in the market so that it offsets the risk of making that investment, because the risk is high, because the risk of failure is quite high. And therefore, I've got to have the high growth to achieve that. That means more investment. So how much have I got to invest? It's that efficiency of the reinvestment that I'm really interested in trying to understand whether it is worth investing in that business and how much that's worth to me. If you have to reinvest all your cash flow back into the business just to achieve growth, to combat the competition in the market, well, you haven't got a lot of value there, have you? Because all your cash is just being reinvested. You've got no residual cash flow. So we're looking for businesses that can do that more efficiently in the way in which they grow. And of course, that's the risk of investing in those businesses. And if we look at that from the SaaS model point of view, the software as a service type businesses, lots of subscription type models, in other words, could be transaction based, could be subscription based in the way in which they work. You're starting off trying to conserve cash, not actually invest too heavily while you search for product market fit, you search for a repeatable, scalable model. You're just testing the market all the time, trying to find out what works, what's actually going to deliver actually this growth for me. And then once you find that, that's when you need to invest aggressively to scale the business up and take advantage of that opportunity. Because otherwise you might miss it because someone else might come in and take the opportunity from you. The size of that market opportunity obviously matters to make sure that we can scale up. And we try to measure this and understand whether the value is possible to create by using a variety of metrics. So we'll look at growth. We look obviously at revenue growth rates. We look at rule of 40. You haven't come across that. That's the combination of the EBITDA margin and the growth rate. And ideally, that should be above 40%. So it means that in my high growth phase, I'll have a negative EBITDA margin, but the growth will outweigh the negative profit. As I slow down with growth, I should see the profitability come through. So again, the combination of the two should be above 40. Most people use a weighted version of that now. So they weight it. They don't do it as an equal weighting on the EBITDA growth, EBITDA margin and the revenue growth rate. They usually weight them in terms of what they look at. But a variety of people use different rules on that. You can use the average revenue per account or average revenue per user. You can use the expansion in the mix of sort of products we get in our annual recurring revenue. How is it mixed? You can look at the cost of customer acquisition. The CAC is the customer acquisition cost, or the time to pay back that cost. The value we're creating in our customer base, the lifetime value, and then you can compare that lifetime value to your cost. So in terms of our investment, what are we getting out of this? The CAC is my investment, and in a lot of these businesses, that's going to be sales and marketing. So how much am I investing compared to what am I generating from that in terms of my customers? And of course, that depends on my churn rate and how I can grow that. And then you go into customer retention. What's my gross retention of my customers? So I'm looking at gross retention from a revenue point of view. So that's my revenue less my people who have actually churned out of the business, always less than 100%. Or I look at net retention, which includes the people who have churned away from the business, but you add in then the upsells and the cross sells and all the other things I might sell to my particular customers. And that can be more than 100%. I can look at logo retention rate. So my logo retention rate is the percent of new customers that I retain. Important to see the growth. And I can look at things like net promoter score. How satisfied are people with me? So I'll look at the negatives and I'll look at the positives. You're looking at reviews, in other words, that you might actually get. And if you've got a promoter score on a net basis of more than 80%, you're fantastic. You're in top percentile. Usually they're less than 50 in terms of net promoter scores. But you look at that in terms of customer retention and expansion. You look at operational efficiency, margins and expense rates and conversion rates of people into actually positive revenue. So on your marketing funnel, look at how you can convert those. And then you'll look at cash conversion. So how much of my profit converts to cash? It'll be very negative for these businesses in the growth phase. But as they slow down, you expect to see positive figures. You look at your recurring revenue on an annual basis to your capital. That's like a return on capital. So what are we generating in terms of annual recurring revenue to the investment? And you can obviously look at multiples if you've got revenue. We're looking at later stage businesses, of course, when we look at that. And all of those give you a feeling for, how successful is this repeatable, scalable business model? And those particular businesses that are successful on these clearly going to be worth more. They've got more opportunity to create that value in the future. So people are benchmarking this. Variety of surveys you can use. I tend to use RevOps Squared, but there are a variety of other surveys that you get. And you can look at it in percentiles in terms of things like retention rates, gross retention and net retention. So gross retention, remember, is the gross revenue I generate less the people who have churned away from the business, always less than 100%. The net revenue just adds in the upsells and the cross sells in terms of other things I'm selling them. And clearly that can be more than 100%. So in this case, if you're in the top percentiles, the fourth quartile, you're actually going to be, 110% or 92%. So you'd be benchmarking businesses against each other here. Other benchmarks I use, Bessemer Ventures, venture capital investor in the market, very useful data. They publish fairly regularly some of these average benchmarks. Always difficult to use averages, isn't it? Because averages, a multitude of sins are within averages, but it gives you some other data you can use. When you're looking at a particular company, you can benchmark it actually against its peer group and say, how is it fitting into this? Therefore, where should we think about value in terms of this? Is it likely when we start looking at a multiple basis to have higher multiples than the average or lower multiples? Why should we be looking at that? Variety of these we can look at. I quite like the last one here in terms of cash conversion score. This is the annual recurring revenue divided by capital. They take off the cash in terms of this particular investment, because that gives you a target in terms of the likely returns that you might get. Because if you've got a 1 times cash conversion here in terms of what you're doing, in terms of your score, it means that a 10 times multiple in terms of valuation will give you a 10 times return on your investment. And that's, what you want to think about from a risk perspective. What do I need in terms of return at an early stage in terms of investment? And therefore you can look at that on that particular basis. That can be quite useful. So what do you think is going to happen to these multiples? Clearly multiples have declined, haven't they, in the marketplace? I think everyone accepts that they've come down fairly substantially in some areas. What do you think is going to happen to them this year? Are they going to continue to decline? Do you think there'll be no significant change? Will there be more of a divergence between various types of technology? Or do you think they're going to actually go up again as inflation falls, or inflation already starting to come down, of course? So do you think then we'll start to see a rise back in multiples? Where do you think these are going to go? So pop the poll up if you can, and we'll see what people think of this one, because clearly this is very relevant for how we start to approach this from a valuation point of view. What's the market doing? How is it reacting to this in terms of multiples? I'll give you a few minutes just to have a look at that. So once we've got a few answers in, perhaps you can just put that up in terms of the responses on that. Let's see what we've got. More divergence, fairly strong in terms of that. Yeah, I think you're absolutely right. That's what I would go with as well. I mean, there are no right answers to all of these. It's a point of view, isn't it? But I think that you're likely to see people being far more selective in terms of what they want to invest in at what particular price in the market, and therefore you'll see possibly a much greater divergence. Whereas previously there wasn't a huge amount of divergence taking place, You would still see some selectively much higher, but it was fairly benchmarked at a high level. I think you're going to see far more of that actually coming through in the future as we progress forward. So yeah, I'd agree with your view on that. I think that's pretty much where I think the market is going. If you look at multiples generally, again, lots of data you can look at. This is Silver Peak in terms of some of the data they produce. And you can see that it's really sort of leveled out. It's stabilized on revenue multiples. Big difference between the US market and the European market or the UK market when we're actually seeing the actual multiple levels. This is looking just obviously at revenue multiples. And they split them into what they call vertical and horizontal. So vertical is just one market. Horizontal is selling to a range of different markets. So slightly different business models that people are fulfilling. What I think is noticeable here when you look at it, and again, they're just medians, so you've got to be a little bit careful of looking just at that data. There's a big variation clearly within that. But when you actually look at the big fall that's taken place in the US multiples, the US multiples went up to 12, 14 times in terms of multiples, and they've dropped back to somewhere around 5 or 6 times in terms of the multiples. When you look at the UK multiples or the Europeans, I mean, they went up to 5 or 6 and they've come back to about 3. So in terms of the actual fall that's taken place, it's been a bit more dramatic in the US market. They seem to get a bit more excited about technology. It might be just the availability of funding in that market. It's always going to be the largest marketplace when you actually look at the tech markets generally. But there has been a larger drop-off in that particular marketplace when we look at it than has been actually in the European or the UK market. And also, if you look at where it's settled now in terms of the market, it's reasonably comparable with what it was about 2019. So it's not actually so bad when we actually look at it from where the market is. Maybe it just got a bit overexcited in the market. If we look at it in terms of M&A trends, this is some data from SEG, that's the software group in terms of software equity group. You can see here that there are a few sectors here that have had revenue growth on a quarterly basis. So if we look at it benchmarking Q4 21 to Q4 22, I mean, there are really only a couple of sectors here where we're actually seeing some growth come through. So you've got business intelligence and analytics growing very rapidly. You've got growth actually, which is better in terms of the enterprise resource planning and supply chain. You've got human capital. All the other areas you've seen drop-offs in terms of growth rates. When we look at it on a multiple basis, they've all dropped. So in other words, you've actually perhaps in some areas had an overreaction to what's happening in the market in terms of the way multiples have gone down, because you've still got the growth possibilities there. But clearly people not willing to actually pay the sort of multiples they were before in that marketplace. That may identify some opportunities clearly in terms of those growth areas, if you think they can achieve that growth at an efficient investment cost. And it's all about that investment cost, of course. More examples here from SEG, just looking at benchmarking. This is obviously the quoted sector where they're looking at a whole variety of companies to form an index. So you've got all the companies listed there in terms of the little box, in terms of what they look at. And they do this on a regular quarterly basis in terms of looking at a variety of factors. Again, I think the interesting thing is you've had a drop off in multiples. So here you've got revenue multiples either on trailing 12 months or next 12 months, forecast multiples, and they've all dropped off very substantially, as you might expect. When you compare that to revenue growth, you can see revenue growth, although it's slowed a little, it's not much. You've still got pretty good opportunities on revenue growth. And when you look at gross margins pretty much the same. So in other words, is this an overreaction in the market and will it start to come back again? Well, I think I'd agree with you. In some sectors, that clearly is going to be the case. I think maybe people have overreacted to what's happened in terms of inflation and interest rates. And as that starts to fade, there'll be certain areas where clearly there are value opportunities. Seeing the same sort of thing when we start looking at in terms of M&A revenue multiples, as an average across overall multiples here. It's gone back to basically where it was back in 2019. It's a little better, as you can see in Q4, but there's this big spike that took place and then it's dropped back. It's not so bad when you compare it to what was happening in 2018, 2019, which was still relative comparison actually looks okay. So I think the opportunities are still there, but maybe it is sector-based. What are the sort of things I would say to watch for, therefore, when we look at this? Well, clearly technologies such as 5G, such as artificial intelligence, such as cloud computing, you're starting to get to mass adoption of that. And then you'll see much more growth clearly coming out of some of those areas. That may be a reflection of some of the growth that you're seeing in those sectors we talked about earlier, where they've still got rapid growth potential in those areas. You've obviously already seen the tightening that's taking place in some of the large tech companies, whereby, they're clearly laying off staff, they're tightening up in terms of their costs, and therefore perhaps, the vanity projects that they might have invested in before, those have disappeared. They've got to now focus on better efficiency of cash investment, which should lead to better value in terms of that. So, the opportunities for the good companies should come through then. They're going to focus clearly on cloud computing and the use of cloud computing. I think that's going to be evident everywhere. You're going to take advantage of security and automating security in the banking financial institution sector. That's probably more fintech in terms of the financial technology type businesses that we see. And there's going to be clearly a trend here in terms of the way in which people look at using the technology in terms of AI technology, the way in which they start looking at machine learning. We've obviously seen it with ChatGPT, Stable Diffusion coming in. You've got those particular technologies that people can use in artificial intelligence to obviously automate a lot of their functionality. And I think you're going to see a lot more of that coming through this year in terms of opportunities. Indeed, I was just reading before we started the webinar this morning in the Financial Times this morning. You've got one of the Magic Circle firms, Allen and Overy, just announcing that they're introducing AI technology for their junior lawyers in terms of documentation. So doing the basic documentation work, they're going to use AI technology to actually replicate that. Interestingly, they're saying that isn't going to reduce the cost for clients. Their fee rates are not going to go down. They're just going to use that internally. Well, obviously, it's going to become a competitive issue, isn't it? And, as everyone starts adopting this, you're going to see quite a number of changes in the way in which people use it. So there are certain areas, I think, where we will clearly actually see a focus. And that's why I'd agree with you that it's going to get selective, I think, in terms of how we look at this. And it's all about then, well, how do we attach that value? How do we look at the efficiency of that investment to create the growth? Because that's the key area. And how do we find a marketplace which is big enough for us to grow into? Because you've got to have the scale in terms of what you're doing. And if you have those components, then you reduce the risk. And that's where you create the value, of course, in terms of the business. And that's what we're looking at with valuation when we actually look at this. Now, a shameless plug for a course that I run is Valuing These Businesses, where we go through this in quite a lot of detail, using lots of practical examples. So picking real companies, either early stage or later stage, and looking at, well, how can we apply all of this? How do we put this into practice? So if you want more practice on that, feel free to join me for that. We run a number of these in the market in terms of technology businesses, looking at this in terms of how can we understand this particular value. And that leads me to the end of my little session. I noticed there are already a few questions actually coming through in terms of your questions. So we'll move on to actually looking at the questions element of that. So I'll just take the actual slides off the screen for a moment and get my picture on there and have a look at some of the questions that you've actually put into the chat window. So let's have a look what we've got here. So how do you go about this? How do you value DeepMind before it gets the support from Google? Apparently no domestic investors recognize the value. Again, it's the issue, I think, in terms of if you're looking at that sort of application, it's two things. How much do I need to invest to develop that? What's the size of the market? What's the competition in the market that will actually be against that? And where is the application? Where do we create around it? If I go back to the idea in terms of Movea, in terms of motion sense technology, it's sort of the same idea. How are we going to monetize this? And once you can identify the opportunity to monetize it, and you can see where that cash flow is going to come from, then you can start to look at, well, okay, how do I actually value that? If you can't identify that, and if there is no cash generation opportunity, I'm sorry, but it has no value. That doesn't mean it doesn't have a price. Somebody still might pay for that, thinking that they can perhaps see an opportunity that you don't see. And it's really trying to understand this particular relationship between how much do I have to invest to achieve the growth, and then how long is it going to take, and what risk do I have in this? At this qualitative, another question, at this qualitative stage, in other words, the early stage, how do you avoid bias thinking? You don't, is the answer to that. We're all very biased, aren't we? It's very difficult to be objective in looking at this. We tend to be subjective when we look at things. I suppose the only way you can try to get around that is that you use specialists in certain areas of technology that have perhaps a better understanding of that sector, that technology, and can better appreciate, therefore, where the advantages might lie. And if I'm being honest, that's one of the problems I find. You know, when I work with clients on valuation issues, I am not a scientist, and therefore one of the most difficult things I find is understanding the technology. And they explain things to me in terms of how this is going to work. I find it very hard sometimes to see where the benefits lie. And so, you know, that is bias on my part coming into this. And I have to try and fight against that, you know, and try and be as objective as possible. But that's always a problem. You know, it's a good question in terms of that. There's a question here about the Berkus method, the early sort of stage, the 5 factors. Should it be weighted for the target sector? Yeah, certainly. As Dave Berkus developed his concepts on this, he certainly moved into an area of saying that, you know, there is a problem with this, that perhaps it should be weighted and we should attach perhaps a slightly higher weighting to certain factors than others. But I think that's probably moving more into the risk model and the risk summation model, where, you know, you can then start to weight those if you wish in terms of how you look at it. So yeah, he recognized the failings in terms of some of the areas. You know, it's early stage. We haven't got very much data, so, you know, it's a simplistic methodology, but it gives you a flavor for where the risks might lie. And I think that's the key in terms of looking at that. Where can the information can be found in terms of the risk factor summation? So where do you get that? You actually, again, it's a bit subjective, but, you know, you're going to have to look at the sector and, looking at those particular risks, subjectively say, where does this company fit in terms of the sector that I'm looking at? And again, it's quite subjective to look at it. All of these have problems. You know, in valuation, it's never actually something which is black and white, is it? You know, we're always having difficulties in trying to make some judgments, but it's trying to make judgments based upon some sound assumptions that we might have behind that. That's the key, I think, in terms of actually looking at it when we actually start to appreciate some of these particular issues. Another question here, would there be a difference in valuation for fintechs and how we look at this? Not really. I mean, I do quite a lot of fintech valuation as a sort of an area of looking at technology. And I think the thing with fintechs is often, particularly from the financial institution point of view, it's going back to this cost of development. Do I actually develop that technology myself internally, or do I go and look at buying a fintech to actually manage whatever I need in terms of that technology? And often, you know, you're talking about things like platforms, and, you know, there are a lot of white label platforms out there at the moment, providing an ability for people to use that platform for their particular use. And the issue often for financial institutions is, do I just buy one of those in terms of the platform? Do I subscribe to the platform and just pay a fee to utilize it? Or do I actually try to develop that myself in terms of that particular application that's there? And therefore, it's that relationship between the cost of development or purchasing it or utilizing it. And of course, it often depends upon, you know, have you got the capability to be able to do that? Banks often are a bit slow. They don't move very fast. And often the new businesses in technology can be more innovative in the way in which they develop that. So often it's better to have a subscription service to it rather than actually buy it. But when we're looking at valuing it, you're then valuing, you know, what is the opportunity for those subscription services in terms of churn rate and the ability to generate new customers in terms of what we see there. Lots of other questions actually coming through, but I notice we are running badly actually out of time in terms of what we're getting there. And as I mentioned, we will address all of those questions after. So I will get back to you via email. So all of the questions that you actually asked will actually come through eventually to you, but conscious of time in terms of what we have here. So I'll hand back to Taya now just to close this particular webinar. And I will just put up the QR code for you. So you need that, don't you?
Well, thanks all for joining. I hope you found that interesting and insightful. John has just popped up a QR code. This is just for a bit of feedback from yourselves. Feedback's obviously really welcome. So it'll just take a couple of minutes to give us that feedback. As John mentioned, we're running the course coming up in a month or so. So if you're interested in that or any other webinars we're running, please get in contact after this. We will be in touch with the slides, a copy of the video, and also all the answers to the questions, as John said. So that will conclude our webinar. Thank you, John, very much for your time. The QR code will stay on your screen for a little bit longer, just to give you time to do that. So many thanks all.
And thank you for me. Bye-bye.